With the start of the new year, undoubtedly, many people will flock to the stock market in order to begin the year in a better financial situation than they ended last year. However, with all the information and misinformation out there about investing, it becomes more important than ever to get your head around a few key concepts before you start investing. The first is knowing your reason why. Understanding why you want to start investing is often the first and most important step. Because if reality doesn't match up with your expectations, chances are you're going to stop investing early and miss out on a great opportunity. You have to understand that investing is not a silver bullet to becoming rich or even a get-rich-quick scheme. In fact, most investors will probably never end up being rich. What investing is a tool to improve your financial standing and your financial habits. It's a way to save money as often as possible with the aim of seeing that money grow into a sizable pot via the power of compounding returns. Stock market investing should therefore be only seen as a long-term generation of wealth and not something which generates cash on its own. Having a financial plan. Having a financial plan allows you to stay on track and provide a rough outline to your investing journey. These goals and milestones could be saving a certain amount by a specific time. The goals should be customized to you and to you only. You should never try to compare yourself with someone else's financial standing, especially not those on YouTube who have millions of dollars in their investment portfolio. For example, a common investing goal might be for retirement, which basically gives a 35-year-old around 30 years to build a pile of cash to which they can use once they retire. Other goals could be something like early retirement or financial independence. These both include amassing a large portfolio in a relatively short time. Whatever your time frame is and your desired amount, it is useful to have a goal in mind with a specific time frame that you want to achieve it. Another concept is save more and spend less. One of the unintended benefits of beginning to start investing is the fact that it improves your relationship with money. People who regularly invest also tend to spend less on non-essentials, such as the more expensive car or even a lot of designer clothes, because usually they'll have a financial plan that they're sticking to, and buying all these luxury items can often set you back quite a bit. So every time you get that paycheck, immediately separate money into different pots, one that goes into investments, one that goes into paying for essentials such as bills and rent, and another small budget for discretionary spending. A great way to save more money is to live below your means. It is astonishing how many people on top salaries are living paycheck to paycheck. This is because it is tempting to want to increase the quality of your life as your income goes up. But what saving really is your income minus your expenses. So oftentimes people on very high salaries are actually saving less than people on much lower salaries. By spending less on things you don't actually need, you can save more monthly and reach your financial goals faster. The next concept is increase your income. No matter how much you try to save, the faster way of increasing your monthly deposits is by increasing your income. By getting into investing, you will realize sooner how important it is to continue progressing through your career or business, and instead of trying to penny pinch to the last cent, you will open up the possibility that by investing in yourself, you can be in a position where you can increase your income. Examples are starting that side hustle that you always talked about but never did, starting a YouTube channel for additional income, or even taking up additional shifts on the weekend when you're not doing much and just watching Netflix on the sofa anyway. Understanding the power of compound interest. One of my biggest regrets of my adult life is not having started investing sooner. Saving and investing in a regular basis and starting as early as possible will allow you to take full advantage of the compounding effect in order to build your wealth. The interest we see on our investment accounts, provided we don't withdraw them, doesn't necessarily just go up in a straight line. After about 30 years, the line begins to become exponential, meaning that your wealth grows faster and faster by each passing year. Take this for example, if you had invested $100 per month with an annual rate of return of 8%, at the end of 40 years you would end up with $350,000. However, if you had stopped investing after only 30 years, you will only be left with $150,000. Without compound interest at all, saving $100 a month for 40 years will only net you $48,000, and most of that will be lost to inflation anyway. Understand the risks. Whilst the stock market is a very easy and accessible way to build your wealth over time, it isn't without its risks. The money you deposit, the capital, can go down in value as well as going up. This is due to the fact that not all companies will continue making money. Some will fail, leaving some investors to lose their money. Generally, those who have higher returns in the stock market take a greater amount of risk. It is always up to you as an investor to determine how much risk you are willing to take and consider if that potential reward is worth that risk. There are, however, ways of mitigating that risk. For example, investing in a diverse range of stocks, or even investing in a broad-based index fund. Investing everything in a company that doubles over a span of few days could mean maximum rewards, but conversely, a company could fall 90% in a few days and all that money could be at risk. Keep your costs down. You would be lucky these days to see even a few percentage points of return on your portfolio. Brokerage fees and transaction fees can further eat into this return, leaving you with less money to enjoy. This is why it's very important to find an account with low management fees, low transaction costs, low account fees, and foreign exchange fees. Luckily, it is now cheaper than ever to start investing due to the rise of many online investment providers with very low costs such as Vanguard, Trading 212, and InvestEngine. And lastly, have an investment strategy. There are a lot of available investment strategies that different investors live and die by. These can range from dividend investing to growth investing. Figuring out what sort of route you want to go down before investing can be especially beneficial. Each strategy comes with its own strengths and weaknesses, and no strategy is guaranteed of making the most return. For example, many investors believe in dividend investing. Dividends are when a company shares its profits in cash, so dividends, to its shareholders. Many investors prefer dividend investing as it keeps them motivated and keeps them on track in their investment journey to reach their financial goals. But then there are investors who say that dividend investing is not the best strategy because if a company gives out a lot of its profits to dividends, then that money could have otherwise been reinvested into the company and the company would have made more profits anyway. Whatever your investment strategy is, it is useful to have one in the beginning and one that you can look over every now and then in case you want to re-evaluate your situation and make a complete change to your investment strategy. This video has taken way too long to film. A very happy new year to every single person watching. I am very grateful for all the people who have subscribed and commented. Make sure to check out some of my other videos and I will see you in the next video.